General Motors out with second quarter results, and Phil LeBeau joins us with those numbers right now. Good morning, Phil.
Good morning, Becky. Let's take a look at shares of General Motors under a little bit of pressure after posting a Q2 earnings that beat the street, also revenue better than expected. But that's really not the main thing that the investor community is focused on. It's really what's the impact of tariffs on margins. We'll talk about that in a bit. Earning $2.53 a share versus the street at $2.44. Revenue better than expected at $47.12 billion. The street was expecting $46.28 billion. Here's the story. You'd look at EBIT adjusted. The profit in the quarter, $3.04 billion versus $4.44 billion last year, down 31%. The EBIT adjusted margin, 6.4%. A year ago, it was 9.3%. This is where you see the impact of the margin of the tariffs that went into effect on April 2nd. Automotive free cash flow, $2.82 billion. A year ago, it was $5.3 billion. North American EBIT profit, $2.42 billion. A year ago, it was $4.43 billion. That North American margin, boy, it took a hit. 6.1% in the second quarter. A year ago, it was 10.9%. If there is good news, if you're an investor in General Motors and you're looking for something to say, well, is there any bright spot out there? They have not changed their guidance. It remains the same as it was on May 1st. EBIT adjusted for the full year of between $10 and $12 billion. EPS in the range of $8.25 to $10 for the full year. And automotive free cash flow in the range of $7.5 to $10 billion. Lots to discuss with GM CFO Paul Jacobson. First on CNBC, that's coming up next hour, guys. And again, the focus here, it's not whether or not they beat the street. It's whether or not the impact on margins, which you clearly see here, down 45% in terms of EBIT. And then the margins they've just been cut down dramatically because of the tariffs. Is that the new normal? Is 6.4% margin the new normal versus 9.3%? That's going to be one of the first questions we have for Paul when we talk to him next hour.
You know, Phil, GM has been pretty clear about the idea that with this $5 billion headwind they're expecting from the tariffs, they could deal with about a third of it by taking care of stuff in-house, getting sharper. Yes. What happens to the rest of it? Can they put pressure on suppliers? Can they expect to pick up some of the rest of that in other places? How do they handle it?
They're clearly eating it right now, Becky. I mean, you look at this. I mean, that's the impact of margins. Your North American margin. I mean, let's be clear here. When it comes to General Motors, when it comes to Ford, North America is the profit driver. That's where it all happens. And because you have a 25% tariff on vehicles built in Canada and in Mexico, or in GM's case, or in Korea, and look, a lot of that can be offset, or not a lot, a certain amount can be offset because of USMCA and ways that the tariffs are written right now. But not all of it, and that's where you see the impact on margin, Becky. They have to eat it. 6.1% margin in North America versus 10.9% last year. I mean, that's the story right there. Now, the counter to that, you may have some people sit there and say, hey, look, in North America, you made $2.4 billion. You didn't die because of the tariffs, and you're still selling vehicles at an average transaction price that has not dropped. It's over $51,000. You are not raising your incentives to the same degree that some of your competitors are in North America. But if you're an investor, it's about margins. You guys know this. This is what we talk about all the time. And that's going to be the first question we're going to have for Paul. Look, they are offsetting some of this by adjusting production, making changes in headcount where appropriate. But at the same time, they're still building vehicles outside the United States, and they have to bring those into the United States. That's not changing. That is not changing. I mean, and that's at the heart of the debate. If you're an investor, okay, is this the new normal if I'm investing in General Motors?